Hello dear students. Let us understand about the importance of cost of capital. Cost of capital is basically the cost of acquiring the funds from various sources. So to raise funds for the business, we need to accumulate those funds from different sources. For all the different sources, obviously we need to give some cost. And that additional cost is actually called as cost of capital. Say for example, if you are taking debentures, so cost of capital there is your interest. If you are considering shares as your source, obviously their dividend will be the cost of capital. So that is what the cost, additional cost apart from the principal amount that what we are paying to our investors is actually called as cost of capital. So let us see its importance now. First one is why it is important to take some decision related to capital budgeting. So capital budgeting in the sense for any kind of investment decision, so capital budgeting tools and techniques, it supports a lot. That is, so whether to invest in a particular project or not, whether the so-and-so project will gives a beneficiary result, profitable result. If it is like that, if it gives positive result, obviously that project is accepted. If it is not, that project should be rejected. For taking those kind of decisions, probably this cost of capital, it supports a lot. Coming to the next decision, that is capital structuring decision. So we cannot simply stick on to only one source. Say for example, I am just taking only debenture as my sole source. No, it is not possible. You cannot simply stick on to only debentures or else shares alone or else retained earnings alone. Not like that. So capital structure is nothing but debt equity mix, combination of debt as well as the equity, that is owners funds as well as outsiders funds. Say for example, 70% I am considering as equity, I am taking equity funds, and the remaining 30% I am taking for I'm just seeking help from the outsiders, that is the debt. So 70 is to 30, that is what my equity debt mix. Okay, so that is what structuring decision, how we are going to structure. See, some portion I'm taking from equity, other portion I'm taking from debentures, and other from shares, and some other portion from the retained earnings. By combination of all the different sources only I can able to accumulate my funds to start the business. That is what capital structuring decision. Again, for that capital structuring decision, so this cost of capital is what very important. Coming to the next, that is evaluation of financial performance. See, this cost of capital, it decides your entire performance of your financial aspect of the business. So whether your business is moving in a profitable manner or else it is going in a loss, all the different things that you can decide from this cost of capital. And last is other financial decisions. It may be your market value of share, yes, or else earning capacity, how much that my business, that I earned from my single share, that is earnings per share. For one single share, how much I earned from my business. So all these things, for identifying, for calculating all these things, this cost of capital, it supports a lot. And next is computation of cost of capital. How to calculate this? Yes, using cost of debt, using cost of preference shares, using equity shares. Another one is cost of retained earnings. If you take cost of debt, two types are there. One is irredeemable, another one is redeemable. So irredeemable is nothing but, so your maturity date is unknown. If it is redeemable, known maturity date. Say for example, a debt period is for 5 years, for 10 years, like that. Similarly, for cost of preference, again irredeemable, another one is redeemable method. So irredeemable is basically unknown maturity date, redeemable is known maturity date. So dividend price approach comes under equity shares. So price, how much it is the cost for per dividend. And similarly, dividend price plus growth is what any additional profit if the company is earning. So for the second method, that is plus growth approach, is also included. And the last is earning yield method. Yield is nothing but the gain. How much earning that I earned from my business. Okay. And the last is cost of retained earnings. Retained earnings is what additional amount that already I kept for my business. Again, I am just reinvesting into somewhere. Say for example, again I am reinvesting in equity shares. That also requires some cost. Okay. So all these things are the different methods for the calculation of cost of capital.